Hey, welcome everyone from the Price Group. My name is Matt Price, flying solo here today. Randy, as everyone knows, he likes to say he's my older brother. He is actually out on a work conference, so I double-checked. He is not playing hooky today, but he is down in Florida, left this afternoon, should be back in a few days. We made the decision last week to move this webinar up from next Monday until today, just given the fact that markets last week had some difficulty this morning. It's been a real roller coaster. You looked at the market this morning, down about 500 points, at lunch down 1,000, and as of a few minutes ago, the market's actually positive. So the roller coaster continues, but we wanted to get some of this information out in a timely fashion. We are recording this, so give us a week or so after this presentation. We'll make sure to send it out to all clients, but we'll get that posted to our YouTube page, and you can pass it along to any friends, family members, or just if you want to rewatch it yourself. But a lot to talk about today, and we've done our best to make this kind of, I'd say, dry, dull, boring data to try to tell a story in this. So be as engaging as you want. On my screen over here on the right, I have my question box popped open. So if I see a question, I'll try to answer it real time. If not, we'll have some time at the end of the presentation for questions. But let's jump right in. 2022 market outlook. Who are we? Randy and myself, 45 plus years of experience between the two of us. Still family owned and operated, and intend to keep it that way. As our clients know, we have a niche in retirement. About 90% of our clients are retired. The other 10 to 20% are on the verge or on the cusp of retirement. We think that's really important for those friends that are not currently clients on this call. From a standpoint, retirement, we think you need a bona fide specialist, someone that eats, breathes, and sleeps retirement every day of the week. And that's the practice Randy created some 30 plus years ago, and what we continue to focus on today. So follow a fiduciary standard. We're not doing what's we think right for the client sometimes. We're doing what's best for the client, we think, at all times. A very salient delineation compared to some other folks out there. So should you listen to us, since Randy's not here, I'll brag on his behalf. We've been humbled to get some awards from Barron's, Forbes, Financial Times. Both Randy and I have our certified financial planning designation. We think that's extremely important. Matty Kearns, who is our newest team member as of 2+ years, he's sitting for his last and biggest part of that certified financial planning test. It's this spring, I think it's next month, but he's a big part of what we do, and if you haven't met him, I'm sure you'll be meeting him in the not-too-distant future. Randy and I also went to the University School of Wharton up in Pennsylvania to get our CIMA, Certified Investment Management Analyst designation. So we think credentials matter. Here's what we're going to be talking about today, though: the economy, financial markets. Key delineation there between the economy and the financial markets. They typically do follow each other, but we'll talk about the differences and where we may be going from here. So without further ado, let's take a little quiz to get our minds warmed up. This is true, so if you want to fact check us, it's fine. A customer in North Carolina liked a certain type of cuisine so much they ordered from the same restaurant 904 times, that's 2.5 times a day, last year in 2021. What type of cuisine was it? And Indian is actually the answer. So I love Indian food. Not sure if I love it 904 times a year or not, but I'd love to see exactly what that gentleman or lady ordered and what the annual bill was. I hope he was paying by the quarter, not by the meal. So last question here: what was the healthiest city as it pertains to eating? When I guessed, I got this one wrong, but the answer was Miami. I thought it'd be Portland, but what do I know? So Miami being one of the healthiest cities according to It was Uber Eats, their online ordering system. So let's jump into the economy here. This chart may look familiar to a number of you. This is called our retirement dashboard. And so what we're doing is we're using 12 economic indicators, and we're trying to determine, to the best of our ability, how the economy is doing. Are we in a healthy spot? Are we in a moderate spot? Are we not looking too good? And so we update this on a monthly basis. We are publishing this by sending it out by email on our blog every quarter. So as you can see here, our latest reading, 10 out of the 12 are positive, 1 is moderate, and 1 is negative. We think that is still in expansion territory, which we like to hear. And so typically the markets will follow how the economy is doing. So we think the fundamentals, big picture, the economy looks good. How did this recipe effect of looking at these 12 indicators work back in 2008? And so here's a look quarter by quarter of, you can see the deterioration of our indicators as we got closer and closer to the financial crisis of 2008 and bleeding into 2009. So we would say 2008 was a fundamental collapse. There were warning signs. We saw those blinking warning signs prior to, able to make adjustments to client portfolios back then. Now, 2020, draw you back to what seems like a lifetime ago, but only 1.5, almost 2 short years ago, to when this virus that no one had heard about called COVID came around. Our indicators here didn't really do us as much good, just because it came out of left field. In 2020, the drawdown wasn't due to fundamentals, but just given the fact that the world temporarily shut down for 30 to 60 days. So barring a black swan event, that black swan event would be something that it comes out of left field, something we're not expecting. We think this is a really good way to help us determine if the economy is in a good, healthy place. So that's why we start out by looking at our retirement recession dashboard. And like I said, happy to report 10 out of the 12 indicators do look positive. Here's another reading. This is actually from Raymond James, where we're spot checking our own work. And as many of you know, we're utilizing a number of different pieces of research to kind of form our own opinions, not only Raymond James research. We now have access to Goldman Sachs research as well, and a number of other companies that we do pay for out of our own pocket. But this is the Raymond James piece. They think the economy is also healthy. Earnings there, pretty healthy. Valuations, I call that moderate to healthy. Corporate activity, which would be dividends, stock buybacks, things of that nature, they view as very healthy. And then the seasonality, where we are in terms of length of the bull market, they'd say moderate to healthy. So good validation, in our humble opinion, that there's other people that are thinking in the same way we are, from a standpoint that the market is not necessarily fundamentally fully corroded at this point. Here's a look back at the last 10 or so years of economic growth of the U.S. economy. So the GDP, the gross domestic product, and you can see the numbers there on the left-hand side, the actual growth rates for the first 3 quarters of last year. We have an estimate there for the 4th quarter, which should be released, I think it's this Wednesday. But those are explosive numbers, and we haven't seen this high of a GDP growth since Reagan back in the 80s. And if that 4th quarter estimate is anywhere close to accurate, it will be the highest rating since the early mid-80s, if I remember correctly. Now, we don't anticipate this to continue. With that being said, we don't think the economy shrinks either. Most forecasts that Randy and I follow and we would agree with will probably see overall growth of 2 to 4% for this calendar year, 2020, which is back in kind of, I say, quote unquote, normal territory when you look back at the past 10 to 20 years worth of data of how quickly the economy has grown. So what we have found out, and you don't necessarily hear this talked a whole lot about on TV, the U.S. economy, the world economy, it's not like a bathtub. You can't just turn the water off, turn the economy off, and then turn it back on 30, 60 days later, and everything's working in the exact same way. It's taken about a year for everything to get back up and running. We're obviously still looking at having some supply shortages. I was at the grocery store just a week ago, and we had to go to option C for the bread we wanted just because the other two bread options were not available. So stocks, the shelves are not fully stocked. Cars are still hard to purchase, go down the list, but we've made tremendous progress from this time 2 years ago. Year over year, last year, look, the S&P 500, the 500 largest companies here in the U.S. were profitable. You saw profits up by over 45%. This is an eye-popping figure. To provide some perspective on that, the quote-unquote normal is 5 to 10% on average. We would estimate that earnings grow by just that, 5 to 10% again this year. And it looks like that's the expectation for most people. So I don't think anyone is necessarily estimating that we're going to see the same type of growth that we saw last year when we're looking at companies, or if we're just looking at the stock market as a whole. But we think earnings growth will be more muted this year, but we do think that there will be some growth to the amount of money that these companies continue to earn year over year. And employment continues to make steady gains in 2021. I've been working with Randy now for 11 years, and I remember having a very similar conversation for 7 or 8 of those years of, hey, we don't think inflation really gets to be persistent until there's wage pressure from the employee. And that's proven to be true in the fact that the employee now really has the upper hand with the employer in having a salary negotiation. There's 2 or 3 companies that need that same employee, where for the past decade, it's been quite the opposite. So this is a real a good thing for the economy, that workers are being put to work. We're going to continue, we think, to see a shortage in the labor market just because there's so many baby boomers continuing to retire each and every month. And at some point, we need to backfill that. We need more people out there working that are skilled laborers. Read a good article just over the weekend that the jobs that need more than a high school degree but less than a 4-year diploma from a college, for example, a plumber, electrician, things of these nature, jobs that are paying $80,000 to $120,000 a year just right out of the gate, are in the most severe lack of skilled workers. So there is a lot of opportunity out there, and but from a big picture perspective, we like that people are going back to work, which means they're spending money, etc. Here's a good statistic from Maria Flynn from Barron's just a few months ago. Even before the pandemic, the MiddleSkill Jobs, which I just kind of explained, more than high school, less than college, make up a lion's share of the labor market. Such jobs like electricians, plumbers account for over half of the USA labor market. Just 43% of the nation's workers are trained to do them. So there's, like we said, plenty of opportunity and a lot of jobs out there. The consumer continues to look healthy, which is a great, we think, one of the 2 key metrics that we look at on if stock prices can and will continue to move higher. So I know this is a little bit of a busy chart. I want to draw your attention to the top right-hand portion of this. household debt service ratio. And if you can see right here, the fourth quarter of 2007, right before the Great Recession, we maxed out a little over 13%, and this is as of the end of last year, right at 9%. We think that's a much more healthy figure, well below the long-term average. What this means is people are not borrowing as much money, which is a good thing. I'm reminded of one of the famous kind of tales of 2007, 2008. Many of you probably have heard it. There was a strawberry farmer in California making $30,000 a year, and a bank lent him money to purchase $1 million home. And the rest is history from a standpoint. We all know what happened with the housing bubble, et cetera, but you're not seeing loans be made like that. You're not seeing people be overly levered, borrowing too much money, whether it's on stuff they think they need or if they just want it. And so the consumer, we think, is in a great position going into 2022. And on top of that, there's some continued pent-up demand. 2020, people really didn't do a whole lot of anything, just stuck around the house. Last year, you started to see people slowly get out and resume a lot of their quote-unquote normal life activities. We think 2022 is going to be an acceleration of that. People continue to get out more, to check things off the bucket list, to engage with society, which by definition means people are spending more money. So, we as humans, we weren't made to just sit at home and sit in isolation. So it's we think a good thing from a standpoint. People are wanting to get back out, and that typically involves stimulating the economy. Balance sheets also are in good shape. This is a look at the cash of the S&P 500, once again, the largest 500 stocks in the country. The cash on their balance sheet, all-time highs, as you can see from last year. We think this is good. You're seeing a lot of this return to investors through dividends, a lot of this being returned through share repurchases, which we can talk about more in detail. But overall, we think companies, for a large part, are in great shape. Now, there's exceptions to every rule, and we're not talking about the companies that have never been cash flow positive, that have never been really kind of made any type of profit, but we're looking at the overall 500 largest companies that really kind of drive us saying, is the market doing well or not? People are typically talking about the S&P 500. So maybe this headline here gets a few chuckles. Government spending is not healthy. So it doesn't take a rocket scientist to figure this one out, but the explosion in money being printed, M1, M2 money supply will be some terms you read about, hear about on TV. We think the velocity of money, that's what's really causing some of this inflation. There's just a whole lot more money out there to be spent than in previous periods. So this is something that really keeps us up at night. Maybe not so what we're worried about this year or next year, but what am I worried about for my kids from a financial perspective, my future grandkids? This would be it, that the government continues to grow at a rate that it just can't keep up. We did a study here recently, and there's been quite a bit of writing on this, of looking back at World War II, how did the U.S. economy come out of all of that type of debt and the money borrowed after World War II? And there's really not one answer, do A, and we can get out of the debt. It was more of a collection of three things. Number one, we grew our way out of it. We had a little bit of a head start when compared to today. We annihilated a lot of our competition of Japan and Germany, and so there wasn't nearly as much competition back then for the U.S. economy to grow. but that would be the biggest driver of how to get out of this inflation, just to grow the economy as a whole. Number two would be to inflate our way out of it. And so this is a little bit of a balancing act on what the Federal Reserve will do in managing interest rates, because they are an obvious, there's a lot of good things that the government gets from having low interest rates. But at the same time, if they can borrow money now and lock in long-term low interest rates and pay those dollars back with deflated dollars, that's another real valuable way to get out of this debt bubble. That's been one of the real head scratchers, is why has the government not borrowed a lot of long-term money, locked in these low rates? They've kept their borrowing really short to medium term, just because short-term rates are still marginally lower than medium or long-term rates. But no one from DC has called and asked for Randy's or Matt's opinion yet. But that has been a real head scratcher of why does the government not lock in some of these longer, lower-term rates, just given the fact of where we are in the interest rate cycle. And then the third way, which I know everyone on the call would love to hear, after the World War II, we taxed our way out of it. So we're not big believers in that we can tax our way out of a situation, but it was, when we look back at history, a combination of those three metrics. But right now, it doesn't seem to be an issue for the stock market, the bond market. This looks to be more of a long-term issue that at some point we have to stop kicking the can down the road. Looking here, supplying delays really eased towards the end of last year. I'm being forced to purchase a new car. If you know me, I'm not really a car person. My Tahoe is now, I think, 15 or 16 years old, and poor thing's just about to putter out. But there's been a delay of finding a new car, and I know I'm not the only person going through that, but we think a lot of this will dissipate toward the second half of the year. GM has a bunch of cars already pre-built, and all they're waiting for are a certain number of computer chips to insert into each car. So that's one of the main drivers to these inflationary figures that you're seeing, are the used car market makes up a big part of that, and then also the new car market makes up a component of that. So we think that inflation is definitely here to stay. We'll talk about that more here in a minute. But some of the supply issues and getting what you need when you need it, we think that hopefully the worst is over. And the real reason for that was shutting the economy down during COVID. And so it's just, we've slowly, after 2 years, worked our way back up to trying to solve all these unintended issues that came about. Like I said, inflation, we think it's here to stay. You probably can tell that by some of the blogs we've written, some of our weekly market commentaries, and the Retirement Insider emails, if you are receiving those. But the Federal Reserve is going to make an announcement this Wednesday. And just to back up, the Federal Reserve, their number one job is to provide a safe and stable monetary system and financial system. So they're walking a little bit of a tightrope here of the stock market, that is, over the last 2 or 3 weeks, has become increasingly worried. What is the Federal Reserve going to do? How much are they going to raise interest rates? What is this going to do to overall equity valuations, et cetera? But at the same time, the Federal Reserve needs to try to keep this stable financial system in place. And so with that being said, they have to get control of inflation. They can't let this thing get kind of way too far out in front of them. You've seen over the past few months, they were saying that inflation is going to be transitory. They're no longer saying that. They think it's here to stay. So we'll see what is said on Wednesday. But we think inflation will be here. We think it is more muted toward the second half of this year. So we do think some of it will dissipate sometime middle of summer through next Christmas. Although inflationary pressures are unlikely to quickly subside, I remain confident in the basic view that the headline and the core number will fall significantly next year. This is a chief economist from Goldman Sachs. We would agree with that. We think it's going to continue for a while, but does not get too much out of control down the road. Turmoil in China. So China has been a real driver of economic expansion from a global perspective when we look at the last 20 years worth of history. And they've grown on average 7 or 8% a year. It's estimated that they're going to grow 3 to 4% this year. Some of the real estate issues you've probably heard about, read about from a standpoint. What really has happened is China, being a communist country, adopted a lot of capitalistic principles about 2 decades ago, and they've used those principles to grow. And now their president is now saying, well, not so fast, my friend. I don't want to lose out on the control that I currently have. And so that would be our main concern is, does China become a closed society again? What is it going to look like on whether it's buying or selling goods with them moving forward? So real question mark we have for 2022 would be geopolitical tension. China, and then everyone's probably up to speed on what's happening with Russia. Is Russia going to invade Ukraine, their neighbor? We'll wait and see, but that would be the real question mark. And going back to our recession dashboard, just not something that we can predict are some of these issues that really don't fundamentally have to do with how the economy is performing. So will the Fed be just right? I sure hope so. Too slow, and when I say too slow, talking about raising interest rates, inflation could rise and higher than they want. Too fast, if they raise interest rates faster than they should, we could see some type of stall in economic growth. We've read anywhere from 2 to 4 rate increases for this calendar year to be the quote-unquote expected number. And just to take a step back, the Federal Reserve controls short-term interest rates. So think about it like your cash at your bank, what the bank is paying you in interest. Those are Federal Reserve controlled interest rates. Now, intermediate term or long-term, 10-year and 30-year bonds, those are controlled by the market. Investors, you, me, pension funds, endowments, whatever it might be. So there's a little bit of a difference there. Historically, when you see interest rates move higher, the medium term and the long term rates will follow. And so we'll see what happens on that front. We have a number of slides here on what we think is happening to the bond market moving forward. But we think a lot of the rise in interest rates has already happened, which we'll talk about here in a moment. So let's look over at financial markets after looking at the economy. Here's one of our favorite slides, and if you've been on a webinar before, you probably recognize it. I know it's pretty busy. We're looking here from left to right. You're looking at about 1900 through the end of last year, and green is good, red is bad. I know that's seems pretty intuitive, but what I want to draw your attention to, the green periods, the secular bull markets. Secular is just a way to say a long period of time. Those secular bull markets tend to last anywhere from 15 to 20 years, and there's really no rhyme or reason why, but that's typically how it works. In our opinion, we think we started this secular bull market back in the spring of 2009, which would put us 11, 12 years into this current bull market. Now, by no means is that a guarantee that the bull market will last for another 2 to 3 or up to 8 years, but it is validity that we think that the market still the economy can still continue to expand, just because historically it has expanded for 15 to 20 years on average. So one of our favorite charts, and that's a question we get a lot. Stocks have gone up the last few years. Isn't this bull market just about to be over? We don't think we're in the 9th inning. We certainly don't think we're in the 1st or the 2nd inning either. So this was what I thought a very timely slide, given the fact that the stock market as of Friday was down close to 10% for the year. Once again, a little bit busy, so let me do my best to explain. The red dots are the drawdown, intra-year drawdown for each calendar year. For example, let's look at the right-hand side, and you can see down here 2020, from peak to trough in 2020, market was down 34%, but it ended the year up 16%. And so the point we're making is, even though there's a big intra-year drawdown, that doesn't mean that the market's going to be negative for the year. There's plenty of data points, unintended with the points, that there are a lot of time to recover from this 8-9% drawdown that we saw so far to start the year. But that's a good segue. People say, well, we have these high, frothy valuations for stocks. Aren't we expecting a downturn in the market? And Randy's answer, my answer is always yes. We're expecting a downturn in the market. Why? Because stocks on average, even during bull markets, tend to have a 10% pullback once a year and have a 20% pullback every 2 to 3 years. So would we expect it? Absolutely. History never repeats itself, but it often rhymes, and we haven't had this 10% pullback since spring of 2020, so coming up on 2 years. Now, in our humble opinion, we don't think that's a reason by itself to just sell stocks and hold cash, because our friend Warren Buffett, he says neither I nor you are smart enough to predict where the stock market will be within a year from now. And if he's not smart enough, Randy and I are not smart enough, and if you are smart enough to time the market, please let us know, because we'd like to hire you. We just don't think it's a good, long-term, viable solution where you can be right more often than you're wrong. Here's another busy chart, but I think it paints a good picture. There are always reasons to not invest. And this is going just the past 11 or 12 years, dating back to March of 2009. So you've probably seen something like this, and just all of the issues that have been presented, whether it's here in the U.S. or across the globe over the past 11 to 12 years. But there's always going to be something. You know, my late grandmother, that was one of her favorite sayings, it's always something. And she was right. There's always something going on that would cause us not to invest. So we don't think just because, oh my goodness, interest rates might move higher, the Federal Reserve might increase interest rates. It's kind of the same song, different dance. There's always going to be something to be a headwind to the market. So that brings up a good question. What actually drives stock prices higher? And fundamentally, if we look at this from a 30,000-foot view, higher earnings and a healthy consumer. And that's what we tend to focus on more than anything else. Can companies continue to make more money than they have in the past? And when they don't, when we have 2 quarters of retraction, that's how we define a recession. But we think for 2022, companies are set up to increase their earnings. And like we talked about earlier, we think we have a really healthy consumer who is able to spend money and wanting to spend money. So block out all the other noise, and there's a lot of noise out there. You've heard us talk about it. You've seen us write it. The media is not your friend. The media does not have your best interest at heart. Through all these different studies, people have found out what sells eyeballs, what sells clicks, and it's fear. And so, you know, the last week or two, I haven't seen the data, but I wouldn't be surprised if CNBC ratings were through the roof, because people are more concerned, thinking they need to get more information, and just if they could watch a little bit more, they'll be more educated to make a better decision. Just if you take away just a couple of things, one of the most important things I'd say to take away from this is block out the noise during times of market volatility, and let's focus on our process. We'll talk about our investment process in more detail here in a minute, but big picture, higher earnings, healthy consumer, those are the two metrics that continue to drive stock prices higher. Interest rates are likely to rise from here, but we think only modestly. For whatever it's worth, Raymond James year-end target is 1.9% on the 10-year U.S. government bond. The 10-year U.S. government bond is just the benchmark people typically use when talking about interest rates. For perspective, we're currently at 1.7%. We started the year at 1.5%, so we've already made a huge move higher this year, and think there could be some room left to run, but a lot of it we think is in the rearview mirror. I want to draw your attention to this chart here on the right. What we're looking at here are the 10-year yields, so the 10-year U.S. government bond. They tend to rise when the tightening begins. What is tightening? Tightening is when the Federal Reserve increases interest rates. And so this north-south line, that's the first rate increase by the Federal Reserve. But here to the left, this is the rise in interest rates prior to any interest rates moving higher. So you see a lot of this interest rate action prior to and then just right here after. So we think we are through a lot of it. People would expect that first interest rate increase in March is the month that is most talked about, but we think bond yields do rise. We'll talk about what that means to an investor here in a minute. So, are stocks expensive? This is a great question, and probably the question we're getting the most currently. We wrote a blog literally titled "Are Stocks Expensive?" and we'll be sending that out by email tomorrow. If the curiosity killed the cat, it's already on our website, so go to the blog section and you'll see it there listed at the most recent blog. But we'll talk about this in more detail, but here are the highlights. If you look at stock valuations compared to history, one can make a fairly compelling argument that the answer is yes. But we don't think that tells the full story, because no one buys or sells stocks when only looking at stocks. They're looking at other investments on a relative basis. For example, what are bonds yielding? What is the cash at the bank doing? And well, we have clients who say, "Oh, I remember the good old days when my CDs at the bank were getting 8, 9, 10%. And that was true. So you had a good option at that point in time when compared to stocks. But those same CDs, the money markets, I mean, if it's not zero, it's a rounding error to zero. Bonds still with historic lows, and so on an interest rate adjusted basis, where else are you going to hang out? You don't want to just have a bunch of cash at the bank. Inflation, by definition, gives you a guaranteed negative rate of return on an inflation-adjusted basis just by holding a lot of cash. Bonds, we'll talk more about that. So we think there is some real tailwind for stocks just because they're the cleanest shirt in the dirty laundry. So if you are a follower of earnings per share, pretty interesting. Stocks using that metric were actually cheaper on January 1st of this year when compared to last year. You say, Matt, Randy, how does that make sense? The stock market was up big last year. Well, it makes sense just because earnings were up more than the stock market was up. And another thing we'll sometimes talk about or point out, high earnings per share, while it is something to think about, it's not something that we solely focus on. And May 2009 is a good example of that, which is the highest earning per share reading on record, above 123. And if we look back to May of 2009, arguably one of the, if not the most or the best time to buy stock in your entire life. So, good saying. I couldn't find who the author of this is, but it's never as good or as bad as you think. And that's probably true for a lot of different seasons of life, experiences in life. Our second or middle child, Harper, we found ourselves at the emergency care clinic last week. She'd fallen at the playground and needed a few staples in the back of her head. And when you just, your child's hurt, you kind of go worst case scenario. But this is something good, I think, in hard times, but also in good times. Things are just never as good or bad as you think. And for those that are so caring and would send me an email, Harper's fine. She got the staples removed, and it's now, she probably doesn't even remember what happened and not even talking about it. So all good on the home front. Here's a quote from Mr. Schiller. It's a name that probably is familiar to a lot of you. Examined on their own, stock valuations are at giddy levels, yet they are far more attractive when viewed side by side with bonds. That's why it's so hard to determine whether the stock market is dangerously high or a relative bargain. And that kind of sums up what we have said to the T. We think it all depends on how you're looking at this, and we don't think there's doom and gloom that the stock market falls apart here and has another 2008 type of experience. At the same time, we don't think that we're going to have repeat returns that we saw last year. And so we're calling for more muted returns. We think it's going to be more choppy along the way, which you've seen here for the first few weeks of the year. But we think there are continued growth with earnings for calendar year 2022. This is one of Randy's favorite slides. Are bonds safe? Look here at three different times of history. The one on the left here, 2020 through 2040, the T notes, which are just intermediate, medium-term government bonds, return 6.4% per year on an inflation-adjusted basis. So all that means is after you factor in inflation, this investment grew by a little over 6% a year. Congratulations, it's a good investment for 20 years, 2 decades. Now, let's look at the second period of time, 1941 through 1981, 40-year period, and the same investment, after we take inflation into account, lost, let's call it 2% per year, round numbers. And so there's a 40-year period where bonds did not make money. And so we've gotten into this place of everyone views bonds as safe and can't go down in value. And that's not necessarily true. When we look back at history, bond or interest rates typically work on a 40 to 50-year cycles. And we're about 40 years into this cycle, thinking at some point the tide has to turn and interest rates start a slow move higher. So with that being said, we don't think that bonds are as safe as they have been in the past. We think it is imperative now more than ever to have a process for how your fixed income is being managed. And 2020 was a great example of that. We put this in our thoughts on the market email we sent out on Friday afternoon. But the overall bond market was down 1.5% to 2% in 2021. Floating rate bonds can increase their income as interest rates move higher. Real estate, lower credit quality bonds, sometimes referred to as junk bonds, have less interest rate risk than, or the lower credit quality have less interest rate risk than maybe a AA or a AAA rated bond, and then some fixed income alternatives. And we talk about fixed income alternatives on a one-off basis with clients. Unfortunately, we just can't really talk about those in detail here, but overall, we're still positioned how we want to be. We probably were a little early to the game. We've been positioned like this for a few years. Last year, it proved to work. So far this year, you're seeing bonds once again down 2+%, and our bond portfolios have not had the same type of downward pressure. We're happy to report. So we think having a process matters. For those of you that are not clients, we would say now is the perfect time for a second opinion as it pertains to your fixed income strategy moving forward. Because what's worked for the last 30 or 40 years is not going to work for the next 30 or 40. So that is the markets. Let's talk about the third section here. We've got about 13, 14 minutes left, so the trains will run on time, and we'll have some time at the end here for questions. But where we may be going, we think U.S. economic growth continues. We think the economy overall grows anywhere from 3 to 4% for this year. And that's back in line with a, quote, more normal number when you take out a 2020 COVID, you take out a 2021, a real sugar high growth year coming off of COVID due to government spending. We think it's going to be a more, quote, normal year of economic expansion for the next 11 or 12 months. The fastest pace of recovery now lies behind us, and we expect strong global growth in the coming quarters. As a whole, global GDP likely to rise 4.5%, and we would agree here in the States, 3 to 4% would be our thoughts. So, question we get: what will keep interest rates low? If you think that we said earlier, we don't think the 10-year U.S. government bond gets above, or it ends the year at 1.9%. It could move higher than that and come back down. We think it ends the year close to 2%. This gets a little bit technical, but if you can follow with me, it's I think interesting is not the right word, but helpful might be a better word to describe this. Let's look here at the middle picture. Pension funds are allocating more towards bonds, fixed income. Why is that? These pension funds have stipulations in place that they have to have a certain percentage of real estate or stocks or bonds or cash or whatever the investment inside of there. And so with stocks having a good year, you're seeing a lot of these pension funds needing to increase their bond percentages just to stay within their investment policy statement is what they refer to it as. And then on the right here, foreign demand remains elevated. You can see dating back to 1990, America, we think, continues their debt, our debt continues to be the cleanest shirt in the dirty laundry, where other countries continue to be more and more interested in owning U.S. government bonds. Now, the real devil's advocate argument to this would be, well, Matt, Randy, have you not been paying attention? The Federal Reserve says they're going to stop buying their bonds, and it's one of the ways they're going to shrink or reduce their balance sheet. And you'd be right. Those would be two competing interests, but we do think that there is some support here to offset some of the slowing of bond purchase, and then eventually just allowing the bonds that the Federal Reserve owns to mature moving forward. So another slide is what everyone wants to talk about: politics, politics, politics. Obviously, a re-election year. It would be our base case opinion. We think we see more red than blue this November, which would create more gridlock in Washington, which could create some additional eye rolls for people watching this presentation. But we look back at history, gridlock is good from a standpoint of stock prices and what happens. So we would say that would be our expectation, would not to get as much done. If you share our concern of the government printing and spending too much money, it's going to be harder for the Biden administration to pass their most recent tax bill, just because in years of re-election, politicians are not as quick to vote for increasing taxes when they're out hustling to try to get a re-election bid. So we'll see if that happens, but we think if the Biden tax bill does go through, it's going to be on a smaller scale, and it could be chopped up, broken up into different pieces. Our crystal ball is always fuzzy. We did write this presentation more towards the beginning of the year, and we said volatility will likely increase. I'd like to give the team the pat on the back that we were at least correct so far this year with this one slide. We have seen an increase in volatility. There on the left, this is the longest period of time without a 10% pullback. So like we said earlier, pullbacks are very normal. We would expect it. I use the analogy, you go on a fun vacation, you go on a cruise, and you ate a lot more than you normally do, and you ate types of food you typically don't eat that frequently. When you get back from a vacation, it's good to go on a diet. It's good to get back on the treadmill. And we think the same holds true with stock market pullbacks. It flushes some of the excess out of our system, which we need every now and then. So we've already talked about a few of these, but increase of Fed tightening, increase of interest rates, midterm elections coming up, still some COVID symptoms that are hanging around, rising interest rates, etc. So we think the volatility is here to stay, but that's not necessarily a bad thing for investors either. This is one of we're always looking at this year over year. This is a very interesting look, and this is it's called the Business Roundtable CEO Economic Outlook Survey. That's a mouthful for me to say. But every year about this time, the top CEOs of large publicly traded companies are interviewed, and they're asked the same questions. Are you going to be hiring? Are you not? Are you investing in your business? Are you not? Are you thinking that sales will grow? And it's historically been a great barometer for what companies plan to do with capital for the next 12 months. And you can see here, on average, they're looking to hire people, which is good. They're looking to increase capital investment, put money back into their business. If business owners or CEOs thought that there's going to be a significant economic downturn, they're not going to be putting capital back into their business. They're going to be holding cash on the sidelines. And they're looking for sales to grow. They benefit from infrastructure investment and Jobs Act. So we were encouraged by this, kind of saying the same thing, but just a little bit of a different perspective. This is Gad Levon, that's how you say it. While we expect wage growth to slow a little bit in the coming decade, a tight labor market that drives wage pressure will be the norm. This is due to the baby boomers continuing to retire without enough people to replace them. That's a quick plug, if I may, for 15, 20 seconds here, for our industry as well. You look at the average age of a financial advisor, and it's over 60. And at some point, we're going to wake up and all this experience and talent is going to retire, as they should. They worked hard and saved on a regular and consistent basis and want to enjoy the fruits of their labor. And so hiring a team that has a succession plan, we think is more critical now to consider than it has been in the past. And happy to report, been with Randy for 11 years. Consider myself the succession plan. I said it was a little bit of a commercial. And then Maddie Kearns will be a future advisor partner of our team as well. So we always want to be overstaffed to meet the needs and expectations of clients. So in summary, here are our thoughts for all of 2022. And we've written about it, we've said it, we don't make stock market predictions just because even the best aren't that good. And but what we do like to do is have what trends are going to be helping us determine if and when we should make changes to client investment portfolios. So inflation, we think it's here to stay, but will dissipate toward the second half of the year. We think interest rates continue to rise. We've seen a lot of the rise already take place. We think American companies will continue to increase their profitability and earnings. We think COVID will be less of a factor at the end of this year than currently. Like we said, the Biden's Build Back Better tax plan, if anything happens, it will be smaller, maybe chopped up into a few pieces. Political gridlock, which we think for the most part from a stock perspective is a good thing. And we think the economy's healthy. 10 out of the 12 indicators continue to look viable. One is moderate, one is negative. But the wild card, we think, is geopolitical tension. And so a lot going on this year. That would be a summary of our thoughts. And even if you are a client, I think this next few minutes here will be very valuable. And how do we marry together the planning piece that is peculiar and specific to each family to all this macroeconomic data that applies to everyone? And our system is by no means perfect, but we call it our Live Well plan. And we call it that because we're a little bit cheesy, but we want our clients to live well. And so we use this Live Well plan to help us make investment decisions for clients. How much money can you spend in retirement? How long will your money last? What rate of return do you need? One of our favorite quotes here by Benjamin Graham: the best way to measure your investing success is not whether you're beating the market, but by whether you put in place a financial plan and a behavioral discipline that's likely to get you where you want to go. And we do just that with our family index number. What rate of return do you need to be, quote, successful? And by no means is this a cap on the upside, but we want this to be your average rate of return over a market cycle. So call it 15 years on average. And we track this against your portfolio. Are we ahead of track? Are we behind track? Are we right on track? And so this is how we determine, hey, how are the Smiths doing? How are the Joneses doing? How are each family, how are they doing compared to their goals? Not necessarily if the market's up or the market's down or whatever's going on out there in the world. Because like we talked about, we can guarantee that there's always going to be bumps in the road. That's just a part of life, and that part will continue. So do I need, or why do I need, an investment process? We think this month's a good reminder of why you need a process. Emotions can be kind of nitty-gritty things that people don't make as clear decisions when there's stress or fear or a combination of both involved. Bring you back to spring of 2020 when the market was down from peak to trough 30+% during COVID. It's times like that when we need to have an investment process. And so discipline and income generation are the core principles for our strategy. Where our goal is to protect capital while generating the level of income that each family needs to be successful. So once again, congruent with this Live Well plan, this family index number, what rate of return you need to be successful. I'm going to skip this slide just for the sake of time to make sure the trains run on time. The dividend income matters. You've probably read about, heard about us talk about dividend stocks, and you might now roll your eyes. This is a breakdown, the royal blue being the percentage of return from dividends broken out by decade. So what does this mean? If the overall stock market returned 10%, just to make the math easy, and 3 out of that 10% was from dividends, you would see this bluish figure in any one of these columns be 30%. But what I want to draw your attention to is dividends really matter over the long term. 41% of the total return comes from dividends. And if you're of the opinion that stocks could move lower or even move sideways for a prolonged period of time, owning dividend stocks makes even more of a difference. And so we continue to look for companies that not only pay, but hopefully can increase those dividends year over year. Happy to report 2020, we didn't have any dividend cuts. Last year, we haven't finalized all the numbers, but no dividend cuts there either. And we're going to be a net increase in the dividend income, not the total return, but the dividend income for the year as well. So we continue to think that companies that have good balance sheets, that have a lot of free cash flow, that are paying dividends and increasing those dividends are a great viable solution for consideration before and also during retirement. So that's the end of our prepared remarks. I know it was a lot. Let's see if we have a few questions here, and shoot us an email if you do have any specific questions. Randy's back in the office, I think, on Thursday, but we'll make ourselves available before then to answer questions that you don't want to. But the line is open per se, and I got a few here that we can start out with. Do you see companies will be able to increase prices enough to overcome labor cost increases? Will the consumer continue to pay a higher price? Do you feel consumer is healthy? Are they healthy enough to continue to spend in higher inflation? A few good questions there. Short answer would be yes. You're already seeing a lot of this, the companies pass through increases of what it costs to create. I'll give you one silly example. Sour Patch Kids, which is the favorite candy at our house with our kids, starting this month, the price of Sour Patch Kids went up 7% across the country. And it's because they have the power to do it. I was buying oatmeal for our youngest child, Lawson, and the amount of oatmeal I was buying, it was $2.20. The time before it was $1.90. And, you know, 30 cents, you say, what's 30 cents here or there? Well, when you do that on a whole shopping cart, it really adds up. So we felt the food inflation. We think that continues. But in the same token, a lot of these companies, given the fact that the consumer is healthy and has low leverage and cash on hand, we think these companies can and will continue to be able to increase prices and pass that along to the consumer. And if you kind of think about it in reverse, it's almost a good thing, because then by definition, that's inflating their earnings. They're going to be earning more, assuming they sell the same amount of product, because they've raised prices. So you've seen that with General Mills so far this year. You've seen that with a number of other companies have talked about on their earnings calls of how they're going to be passing it through to the consumer. But that is a critical point that we are focusing on companies that we think can continue to do that moving forward. See if we have any more. Looks like that is the only question we have now. But like I said, let us know if you have any more. We are here. So want to say thank you for your time. I know it's valuable. From Randy, myself, that's Maddie there on the left, Tiffany and Melissa. It's certainly a team effort here. And please let us know if you have any questions. And stay warm and stay dry out there. Thanks. Talk to y'all soon.